Hey guys, Whitney here. Welcome to another episode of the Ash Wealth Show. We do this episode every single week. Whether you've purchased real estate before or have several rentals under your belt, you're in the right place. Because, see, maybe you've tried to buy a rental before and got stuck in analysis paralysis and lost all your confidence. Or maybe you've invested in a few deals before, but have hit a ceiling of growth in your portfolio. Or maybe you're just so overwhelmed by all the information out there that you're just plain stuck. This is you, you're in the right place. You see, I started investing in 2002, living, flipping, and house hacking. And I was able to build up some buckets of money. But what I realized is it took me a few years to realize this. I didn't have my financial independence. I didn't have my time freedom. I just created another job for myself. And it's when I learned how to turn that equity into cash flow that I was able to unlock those golden handcuffs and really buy back my financial independence and my time freedom, which allows me to do cool trips like this, spending time with my family, traveling the world, and spending my time with you as the investor. And it's been, what we see, I think, with most people that we try to learn from is that we see the tip of the iceberg that's sticking out of the water. My husband and I, we've been able to accumulate several million dollars in assets, mostly in the residential space. We've done a considerable amount of flipping, but really none of our portfolio growth was possible until we got our 30 core assets, our 30 bird properties, where we were able to refinance out all or majority of our capital and move it forward into the next project. Now, we're going to talk about this a little bit today, the state of the market and what this means for the bird investor. But I want to tell you that we did all this while working a normal job, being parents, being spouses to each other, and taking care of their families. So I know that's one of the biggest hurdles that you probably feel is like, how on earth can I get this all done? You can. And it's a matter of using the principles that I teach here in order to make things systematized and run it like a business. And that's what makes what I'm going to share so different. Is because over 18 years of investing, I've discovered three pillars that you have to have in place in order to run a real estate business, or at least get it initially off the ground. One, you have to have the right roadmap. You have to have an investing roadmap that will get you to financial independence in a fraction of the time. If you don't have a roadmap, you're going to be wandering all over the place, making mistakes, and not have a really good filter for understanding what investments you really truly should be going in. And that's painful, it's costly, not only in both time, but in money. Once you have that roadmap, you need to be able to implement it. You have to have a formula for simple, repeatable systems. And unless you don't want another job, you need to be able to put a team in place to execute these systems for you. That is what I love doing. It's helping people understand how to run this like a business, and you be the business owner, not the business operator. And then if you want to scale, you have to learn how to do it using other people's money. Okay, there you can totally reinvest all your profits back in the business. But if you want to throw some gas on the fire and really scale, you have to be able to utilize other people's money safely and effectively to accelerate your wealth build. But it's the results that you're here for. And the results that I've been able to demonstrate, not only for myself, but for others, is that you can build a portfolio that allows you to have 100% control and choice over your time. And so let's dive into what we're going to be talking about today. And that's the state of the market. Okay, we're launching this webinar in June of 2021, and things over the past year look so different. So let's dive into this. Let's talk about asset prices. We probably are all feeling and seeing around us asset prices soaring. We're feeling like we're getting priced out of the market. And you're probably right. I mean, there's a lot of contributors to this. One, there's a historically low mortgage interest rates. An increasing number of people are working from home. So they have more time on their hands because they've gotten rid of their commute, and so they can actually look for another property. But also they're feeling the crunch that they actually need more elbow room. Okay, and so they're spreading out into secondary and tertiary markets. They're looking for land. They're looking for places to homes to where they have multiple rooms and actually create a home office. And we have historically low supply. Now, that's not just characteristic of 2021. We've been on this trend since, the Great Recession back in 2008 to 2010. Housing starts, housing builds just really haven't been there. And we're starting to see more and more people, make that transition into needing to purchase a home or rent a home. And that there's just an incredibly low supply of homes to begin with. And then you couple that with people not really wanting to move around because if they sell their house and then all of a sudden they got to go buy another one, now we've got a low supply on the actual housing market. But we have really high demand. Okay, there's a lot of demand. There are a lot of buyers out there that would like to, get into, buying their first property. Maybe they're downsizing, a retiree that's downsizing. Maybe they've got a little bit of extra money saved up, from this past year, and they actually can put down the down payment. So we've got a lot of demand in the market. And we actually have a lot of money going into the real estate market because the federal government is buying about $40 million worth of $40 billion worth of mortgage bonds every month, okay, to keep that side of the market going. Now, let's talk about the trends. How does this translate into numbers? Well, again, that low supply, tangibly, we're seeing a 38% reduction of inventory since 2020. Okay, so it was already bad in 2020, and now we've seen it a 38% drop there, which equates to about 2.5 months of housing supply on the market. So, of all the houses that you see for sale, really, they would all be absorbed in 2.5 months. Now, that's compared to 4.6 months last year. And even before that, the average was 6 months. So we have an really artificially, well, I shouldn't even say artificially, but a really constrained supply. And the National Association of Realtors actually estimates that we are very, very underbuilt across the United States, and that in order to deliver the demand, we would need to build another 5.5 to 6.8 million homes in order to meet the housing demand that we have. Now, all of these things combined together are driving the asset prices. Okay, now let's talk about the actual trends on the asset price. Well, the asset prices since May 2020 have been going up in the Northeast. It's not all equal across the United States, but generally in the Northeast, we're seeing a 17.1% increase. Midwest is 18.1% increase. South, is 22.6, and then West is 24.3. Now, that is just huge jumps that we've seen in the past 1 year. Now, if you're an investor trying to get into, either, add to your portfolio or get into the market, you probably have noticed a problem. If asset prices are soaring, you've probably noticed that rents aren't keeping up with that. Because nationally, just across the nation, rents, we're seeing about a 3 to 5% increase in rents. Now, for one bedroom, it was 3% nationally. 2 bedrooms, it was 5% increase. However, when we start getting into like a 3-bedroom, 1 bath, or 3-bedroom, 2 bath, we saw those are more desirable homes. We're seeing some stretching in the elbows here, and you're seeing upwards of 7, 8, 9%. But again, when the housing asset is increasing at 20% and rents are only able to go up somewhere between 3 to 9%, you've got a disparity going on here. And I just included some of the top counties and their rent growth over the past years, since May 2020. Now, I'll just throw out some of this data here so you can see it graphically, okay? You can kind of see how things are like bumping along here over the past year. And there's another unique trend, and I want to kind of pick this apart a little bit, is who is actually renting in the market. We're actually seeing a lot more high income earners enter the rental pool, which is interesting. It's a good indication that there's just a lot of constrained supply out there as far as sales, and they're actually getting into the rental market because they're not able to afford the houses. And we'll dive into this a little bit deeper in a future slide. All right, so now we have more renters in the market. So that's good. That bodes well for the investor. And let's talk about the reason why we have more renters. One, maybe the person can't get financing. Okay, maybe they're too young to get financing. Maybe there's just not enough housing supply in their area, or they're unable or unwilling to take on the risk of buying a house, which could be potentially at the top of the market. A good chunk of the people that are eligible people to buy homes right now are the millennials, and they're very career minded. And so we aren't seeing a lot of millennials move into buying a home asset for themselves. These are people that actually saw their parents probably, get hit very hard by the Great Recession. All right. Maybe, if it's a young person entering the market and their parents need to help them with the down payment because the asset price is so high, maybe the parent can't actually do that. They can't actually fund it. And again, maybe the asset prices are just too high in the area and they fear that there might be a crash coming. All right. We also have to take into account of the cost of living increases. And, I've done a webinar on inflation. And so definitely go back and check that out on just how inflation's impacting the housing market. Rents are rising fast. As we saw, there's a difference between the asset prices and rents. But maybe that the rental increase is more attainable for somebody than the increase in the housing price. There's also a lot of competition right now. We're seeing a lot of movement out of major metro areas, especially on the eastern and western seaboards, where there tends to be very high affluent jobs. A lot of people are buying their properties all cash in the Midwest and West. We're also seeing a lot of downsizing of retirees. They're taking the opportunity to get out of their more expensive homes and buy more of these starter homes. And there's an intense competition for a first-time home buyer and then a retiree. And again, we've talked about it, supply just is not caught up with the demand. And then as always, there's always the issue that a renter is unable to qualify due to debt to income on the property. So we have more renters entering the market. We have higher asset prices. Rents are moving up, just not as quickly. What's happening with the investor? Well, we're actually seeing a lot more competition with the investor because there's been a flight to safety out of the stock market with it soaring to, huge highs. A lot of people have, over the past year have pulled money out of the stock market and are looking for harder assets that cash flow. And these are just some of the cities that we're seeing an intense competition on. As you can see here, investor demand, our strong and medium investor demand, and also development areas that are quite popular across the United States. All right, so how can you, as an investor or a potential investor, combat all this economic pressure on the housing market? Well, for one, I really encourage people right now with the data that we have to reset expectations. And it's not to lower expectations, not to lower standards, okay, but reset what you're seeing in the market, okay? So I'm encouraging people to start using a 0.7 rent to value for rent-ready properties or turnkey properties instead of a 1% rent to value. Now, why, it seems like we're settling a little bit. Why would we do that? Well, rents will eventually catch up when asset price increase slows. Okay, so rents will continue to inflate over time and those rents will catch up. So right now, in most major market areas that are very high growth areas that are very solid, you can still get a great rental at a 0.7% rent to value. Now, if your strategy is more of a BRRRR strategy, you might want to consider, instead of going for the home run BRRRR where you're pulling 100% of your money out, maybe consider being all in at somewhere between 80 to 90%. Now, you may be asking yourself, why would I do this and take on all that risk of the construction and the headache of a second refinance? Well, because you can actually lock in historically low interest rates on that second refinance, get a little bit of that cash out, and now you have a rehabilitated property in a great market and still have a little bit of equity cushion left in that property. So BRRRR is still a financially sound investment strategy. Again, this is all about repositioning, resetting your expectations for where we are in the market cycle. All right. Also, if you're executing more of a BRRRR strategy or even a turnkey strategy for that matter, you might want to consider a property that you could target for a second refinance, say at the 1 year or 2 year mark, This is great for, high growth markets where we're seeing that, 18, 19, 20% bump annually. Okay, eventually that will slow over time. So we want to make sure that we're still utilizing the fundamentals, meaning that we're buying in desirable markets. We're looking for those properties that are affordable, B and C plus properties. And my logic behind that is that you get multiple exit strategies. You could flip to an investor, a retail buyer, or even potentially sell back to a first-time homeowner or do a lease option to the tenant. I still love value add strategies, okay, where you get properties, below value and rehabilitate them. So you can, extract equity out of the property. We just may want to extend our timelines on when all that equity comes back to us. It might not all come back to us in 90 days, rather in a couple of transactions over time. Definitely still focus on growth markets. Okay, we want to make sure we're putting all those market indicators in our favor. And I've done a whole webinar on that. You can go back and take a look at how to analyze the market. Two things in your market analysis that I would really focus on right now is making sure that you have a very strong rental pool. Okay, that you're not investing in a city where we're seeing a lot of flight from. Okay, that there's actually people still moving to and that renter base is increasing. Okay, that's going to put you in a nice position. And where there are very good supply demand metrics, meaning that the supply is low in your area and the demand is high because you have a strong renter pool. All right, so my challenge to you, adjust your underwriting criteria, to what we just covered on the last slide. Make sure you underwrite the renter pool and underwrite the supply demand for the markets that you are investing in, right? And then make sure, as always, stress test your assets with the current rental pricing and make sure that they cash flow. Okay, so we don't necessarily want to underwrite the asset for future cash flow. Okay, that is, it's a form of speculation. We want to put that card in our favor and make sure we're in markets where it will grow. However, you want to understand how the asset's going to perform right now. And then one of the best things you can do is lock in long-term fixed interest rate debt on all your properties and help reduce your interest rate risk. Because if you can, lock in, at minimum a 10-1 ARM, why not do a 30-year fixed interest rate right now? I mean, rates are so low. If you can lock that in, you can ride out the market cycles, for a very long time. All right, guys, I hope you guys found this time well spent. If you did and you want actual help building your portfolio in this changing market, I have got the solution for you. We have our Investor Accelerator Mastermind open. Let me tell you a little bit about it. This is for the investor who's just starting out, hasn't done a deal yet, or you have a few deals under your belt and you're doing this more full time and you want to scale. And we had the Investor Accelerator Mastermind. And in this mastermind, I like describing it like the 4 legs of a table. Okay, if you have 4 legs on the table stays upright, it's very stable. You can build on top of it. If any one of these legs are wobbly or missing, the table's going to wiggle and it's going to maybe even collapse. So the first leg is you have to have the right education. And so we provide you with the right education to understand how to invest in majority of market conditions. And then from there, you have to have that investing roadmap. So we help you create that lean investing roadmap, giving you all the tools to build the right mindset, vision, and strategy so you can continue to grow and level up. And then on top of that, we give you the right systems so you can build the right team and run your business with ease. I mean, we literally give you all of our checklists, scripts, templates, even share with you all of our contacts so you can shortcut your path to success. And then lastly, the last leg is having that support to scale. So we're going to actually put you in an environment where we're having bi-weekly mastermind calls. One is centered on building your education and skills. The other one is centered on you working your plan and growing, expanding your goals. And then we have a couple of touch points in between, like various hackathon sessions, so you can get your questions answered. And then we have our online community, so you're never left hanging out there with a question, waiting until the next mastermind meeting. And just imagine, with all this education, planning, systems, and support, how far could you scale your portfolio? Well, if this is of interest to you, let me show you what to do next. Jump on over to ashwealth.com/apply, fill out a quick little application there, and let's hop on the phone and make sure it's the right choice for you. Thank you so much for spending your most valuable resource with me today, which is your time.